Let's go to Rick Santelli at the CME, the data dude.
Yes, the data dude. Initial jobless claims for the week of October 14th, Steve, expected to be 210,000, not meant to be. We broke under 200, 198,000. 198,000. You have to go back to early January of this year to find a lower number in the form of 194,000. Last week was revised from a 209 to 211,000. Continuing claims, a different direction, expecting slightly over 1,700,000. Well, a little bit more than we bargained for, 1,734,000 to a slightly revised comp of last week of 1,705,000. 1,734,000. Well, you have to go back to second week in June to find a higher number in the form of 1,761,000. Philly Fed for the month of October expected to be down 7, is down 9, and that means we now have 10 of the last 11 months. So the 10 reads we have, because this is obviously an October read, have been negative. The 1 month this year that was positive was August, and August was positive 12. So we went from minus 13.5 last month to minus 9 this month. And there's a couple things to point out, Steve. I know that Mike was showing the TLT chart. I like that chart, too. The problem there is that if you look at the highs and then the lows that we're at now, there's a wave count there for Elliott wave, and it doesn't look like the fifth wave's complete. So even though we're resting on an area that historically has had consolidation, you need to be a bit careful there. And the big news might be dollar yen. Look at intraday the dollar yen, getting ever closer to 150. How rare is 150? I'll tell you. On the 3rd of October this year, we had an intraday violation up to 150.16. Didn't close above 150. We've had one close above 150 since 1990, and that was October 20th of last year. And the close was 150.15, only one day. You have to go all the way back, as I said, to 1990 to find a continued effort of trade above that level. It's very significant, and the world is watching is that weakened currency, of course, and their controlled interest rate complex do give them an export edge.
Rick,
Steve,
that's a really important point, but
you.
I do have to ask you, how important is 5%? Is it the psychologically significant 5% or psychologically insignificant 5% on the 10-year?
You know, all the big round numbers are significant, whether it's 4.5, 4 3/4, but 5% especially. Remember how tough it was to get through 4%. But having said that, even though there is a psychological technical resistance there, I don't see it as long-lasting. I continue to say we're guns hot on the long end. And what we're doing, we could debate about all the reasons. But, hey, I think the Wall Street Journal picked up my main reason, term premiums. How much extra do you require from Uncle Sam to go from a 5-year to a 10-year on lending them money, or from a 10 to a 20, or from a 10 to a 30? Those distances are widening. And if you look at historical spreads, Steve, especially things like 10s versus 30s, which right now is hovering, around 24 basis points. Historically, we could get that out to 140 or 150. So these things can continue to widen, and it's that widening, I think, that's one of the big driving forces, along with supply, which translates in my world to debt, that's moving those rates higher.